Hello everyone, welcome back. In our previous lecture, we have covered horizontal analysis of financial statements. During this lecture, we'll cover vertical analysis of financial statements. Vertical analysis is also known as common size analysis of financial statements, and this is a technique for evaluating and analyzing financial statements that express each item in a financial statement as a percentage of a base amount. Here is an example. For example, current assets as 22% of total assets. Here, total assets is the base amount. If we look at the income statement here, selling expenses are 16% of net sales. Here, net sale is the base amount. Let's look at the vertical analysis of balance sheet of Chicago Central Company Limited. So over here, total assets and total liabilities and shareholders' equities are the base amount. If we look at 2019, current assets are 22.6% of total assets. And if you look at 2020, current assets are 23.8% of total assets. So from here, we can conclude that current assets increased from 22.26% from 2019 to 23.8% in 2020. Now, if you look at total liabilities decreased from 80.7% as a percentage of total liabilities and shareholders' equity from 2019 to 77.9% as a percentage of total liabilities and shareholders' equity in 2020. Here is a vertical analysis of income statement of Chicago Central Company. So if we look at gross profit, you can see that gross profit as a percentage of net sales are almost equal in 2019 and in 2020. So over here, net sale is the base amount. Now, if you look at the income from operation, you can see that income from operation decreased from 16.2% to 16.2% in 2019 to 15.9% in 2020 as a percentage of net sales. Now, we look at net income. From the net income of vertical analysis, we can see that net income increased from 9.2% in 2019 to 9.4% in 2020 as a percentage of net sales. We can also do vertical analysis for intercompany comparison. Now let's look at the cost of goods sold for both Chicago Central and Giant Mills Incorporations. Cost of goods sold for Giant Mills Corporation is 64.4% as a percentage of net sales, whereas it is lower for Chicago Central, which is 56.0% as a percentage of net sales. Now, if you look at the gross profit, Chicago Incorporation has got higher gross profit than Giant Mills as a percentage of net sales, but in terms of income from operation, Chicago Central has lower uh, lower percentage of income from operation as a percentage of net sales if we compare it with Giant Mills Incorporation, which has got 16.5% as a percentage of net sales. Now, if we compare net income, we can see that Giant Mills has got 10.2% net income as a percentage of net sales, whereas Chicago Central has got 9.4% as a percentage of net sales in as a percentage of net sales. Now, if we want to conclude that, we can see that cost of goods sold is comparatively lower for Chicago Central as a percentage of net sales, whereas it is higher for Giant Mills. Then gross profit is comparatively higher for Chicago Central, whereas gross profit for Giant Mills is comparatively lower. But income from operation and net income is higher for Giant Mills Incorporation. So overall, we can say that Chicago Central should decrease its operating expenses because it has lower cost of goods sold, but it has much higher operating expenses as a percentage of net sales, and as a result, its net income is lower than Giant Mills Incorporation. That's all about this lecture. In our next lecture, we'll look at limitations of financial statement analysis.